apparently we have a problem. New data just got released on student loans and it's much worse than anyone could have predicted. Normally I would wait until I had more polished research to make a video like this, but this is urgent and we need to get you up to speed with exactly what's happening because this is not normal. For the first time since the 2008 financial crisis, we have the perfect storm of events all taking place at the exact same time, creating some of the most dangerous economic conditions we've seen in over a decade. And it all centers around something affecting 45 million Americans directly, but impacts every single person in this country. So even though I'm rushing to try to get this information out as quickly as possible, let's talk about exactly what's happening, why student loans have become a systematic threat to our entire economy, what this means for you, and then what history tells us is most likely gonna happen next. But before we start, if you appreciate me breaking down complex situations like this one and getting you the real information that mainstream media won't tell you, all I ask in return is that you hit the like button or subscribe. Thank you so much. And all of this begins here, the student loan debt explosion that nobody saw coming. Look, even though this sounds like something we should have predicted, it's really shocking when you break down the numbers. On the surface, our entire economic system is built on consumer spending. When Americans have money to spend, the economy grows. When they don't, everything starts falling apart. And right now, we have 42.5 million Americans carrying collectively 1.814 trillion in student loan debt. Think of it like this. Every month, millions of Americans have to choose between making their student loan payment and spending money on literally anything else in the economy. According to the Education Data Initiative, the average federal student loan balance now is $39,075 per borrower, while the total average balance, including private loans, hit $42,673. This means there's a consistent drain on consumer spending power that's never existed in previous generations. And now that drain is making money flow out of productive economic activity and into debt service instead, which is what's been happening with American consumers for more than a decade now. Between 2006 and 2024, the total national student loan balance increased by 265%. And that's not a typo, it's nearly triple than what it was 20 years ago. And they could get away with this massive debt accumulation because until recently, most of these loans were in various forms of deferment, forbearance, or payment suspension. Students and recent graduates weren't actually paying, so the economic impact was hidden. Now, in most cases, this isn't that big of a deal when the economy is strong and wages are growing faster than debt. But recently, something's changed because while student debt was exploding, wages for recent college graduates actually declined. According to the Education Data Initiative, inflation-adjusted starting salaries for college graduates declined 2.58% from 2007 to 2022. At the same time, the average federal student loan debt has a compound annual growth rate of, get this, 4.94%. And this created a very dangerous situation where borrowers were taking on more debt every year while their ability to repay that debt was actually getting worse. And on top of that, historically, student loan default rates have been relatively manageable, but that was largely because of the various forbearance and deferment programs that allowed borrowers to pause their payments. So borrowers could temporarily avoid default while their loan balances continued growing through interest accumulation. But by the time they actually had to start paying, their debt had grown to completely unmanageable levels. As an example of this, in really simple terms, imagine a graduate in 2020 who borrowed $30,000 for college. If they went into forbearance for 3 years at 6% interest, by 2023, they would owe approximately $35,800. Then imagine if they got a job making $45,000 per year and suddenly had to start making monthly payments of $400 per month on a loan that's now 20% bigger than what they had originally borrowed. However, there is one factor that could either be the biggest blessing or curse when it comes to this crisis, and that would be payments resuming. In our previous example, students got very accustomed to not making payments during COVID-19. Federal student loan payments were paused for essentially 43 months from March 2020 through September 2023. During this time, according to the New York Fed, the delinquency rate on student loans fell to less than 1%. But when payments resumed in October 2023, something unprecedented happened. Not only did borrowers have to start paying again, but many discovered their financial situations had actually gotten worse during the pause period. According to the Federal Reserve's 2024 report on household economic well-being, 57% of borrowers with student loans for their own education reported they were currently required to make monthly payments as of October 2024. That's a massive jump from the 37% who reported making payments in 2022. This, of course, seemed like a manageable transition until it wasn't. That's right, the resumption of student loan payments has triggered what many are calling a delinquency crisis. In the first quarter of 2025, after a one-year grace period, 7.74% of aggregate student loan debt was reported as 90 days or more delinquent. And to put that in perspective, that's an increase from less than 1% in Q4 of 2024. Or put another way, imagine you borrowed money expecting to pay it back over 10 to 20 years. Then you had a 3-year break where you didn't have to pay anything and potentially even forgot about the debt entirely. Suddenly you get a bill that's 20% bigger than you remembered, your income hasn't kept pace with inflation, and you have 30 days to start making payments or face serious consequences. Unfortunately, this is the exact situation that just happened to millions of Americans. According to Liberty Street Economics, more than 6 million borrowers are now either past due or in default on their student loans. Even worse, 2.4 million of the newly delinquent borrowers had credit scores above 620 before becoming delinquent, meaning they went from being creditworthy to potentially unable to qualify for mortgages, car loans, or credit cards almost overnight. And what do? Unfortunately, this is exactly what's happening right now. And when you spread this across trillions of dollars in debt, affecting tens of millions of consumers, you really have quite the economic storm brewing. Essentially, all of this means is that trillions of dollars in consumer spending power has been permanently removed from the economy, creating this cascading effect that most people don't understand. In terms of how severe this impact is, economists are already comparing the rise in student loan debt to the housing bubble that predicted the 2007 to 2009 recession. According to the Education Data Initiative, each time a consumer's debt to income ratio increases by just 1 percentage point, their consumption further declines by 3.7%. Think about what this means. We're not just talking about people having less money to spend. We're talking about a mathematical relationship where every dollar of student debt reduces economic activity by nearly $4. The Consumer Financial Protection Bureau received over 14,000 official complaints regarding student loan products and services in just 2024 alone, with 71% specifically claiming problems dealing with loan servicers. And this suggests the system is not just financially unsustainable, it's operationally breaking down. Some people might wonder why this matters if you don't have student loans yourself. Well, the answer is that consumer spending represents 67.7% of US GDP, according to the Bureau of Economic Analysis. When 45 million Americans suddenly have less money to spend, the entire economy contracts. And here's where it gets really concerning. 18% of student loan holders find it difficult to buy daily necessities because of their student loans. 35% of borrowers opted not to take a vacation due to their student debt. 31% delayed a car purchase, and 22% have postponed starting a business. Remember, when people don't buy cars, the automotive industry suffers. When they don't take vacations, the travel and hospitality industries contract. When they don't start businesses, innovation and job creation slow down. This creates this deflationary spiral where reduced consumer spending leads to business closure, which leads to job losses, which leads to even less consumer spending. All of this accumulated into what we're seeing now, a rather large systematic reduction in economic growth potential. The thing is, this creates a lot more problems, which even creates a bigger economic contraction, which creates even more problems, and the cycle repeats itself. Although the reality is, this is just the tip of the iceberg on top of everything we have going on. We also have the courts systematically blocking relief efforts. Just a few months ago, several federal courts effectively shut down the Biden administration's most ambitious attempt to address the crisis, the Saving on Valuable Education SAVE plan, which was designed to lower monthly payments for borrowers and provide faster pathways to loan forgiveness. That's been completely blocked by by Republican-led states. According to the Department of Education, the SAFE plan had enrolled over 8 million borrowers who were seeing drastically reduced monthly payments, with 4.5 million borrowers qualifying for $0 monthly payments. But in February 2025, the 8th Circuit of Court of Appeals ruled the entire program was unlawful. When the SAFE plan was blocked, those 8 million borrowers were placed into forbearance. But here's the critical part. Starting August 1st, they'll be required to start making full payments again with interest that has been accruing during all these legal proceedings. The problem is that historically, when relief programs get blocked and borrowers are forced back into repayment, default rates spike dramatically. We saw this exact pattern during previous forbearance periods, and it's not like borrowers suddenly developed better financial situations while their cases were tied up in court. Instead, they've been planning their budgets around reduced or zero payments. Now they're facing payment shock where their monthly obligations could double or triple overnight. In these cases, the economic disruption is not caused by the original loan terms, but rather the sudden policy reversals that force borrowers back into repayment schedules that they really can't afford. And this has been the case the last several times with major changes to student loan policy. The disruption itself becomes even more damaging with the underlying debt problem. So with all this in mind, are we heading for economic catastrophe? Well, not necessarily, but there are some very concerning patterns emerging. And this is precisely maybe why some very smart investors are positioning themselves defensively. No joke, I think that some of the most successful investors and business leaders are out here playing chess while everyone else is playing checkers because their timing has been impeccable. A few months ago, Warren Buffett made headlines for dramatically increasing Berkshire Hathaway's cash position to over $277 billion. While he didn't specifically cite student loan concerns, his moves suggest he's preparing for some kind of economic contraction that could create buying opportunities. Similarly, many of the smartest entrepreneurs I know have been quietly shifting away from businesses that depend on discretionary consumer spending and towards businesses that provide essential services to help people reduce their expenses. And this makes perfect sense when you think about it. If 45 million Americans are about to have significantly less disposable income, businesses that sell luxury goods, entertainment, dining out, and other discretionary items are gonna struggle. But businesses that help people save money, increase their income, or provide essential services at lower costs are going to thrive. Essentially, these investors raise substantial amounts of cash and reposition their investments before the full impact of the student loan crisis becomes apparent to the general public, which is a very strategic, smart move. Although in terms of what this means for regular people like us, here's where things get very interesting with how we should be positioning ourselves. As of now, some economists are calling for emergency economic interventions to address what they're calling the pending student loan recession. Others say we're already past the point where traditional monetary policy can help since the problem is structural. Now, if you think, oh great, the government will step in and fix this, keep in mind that every proposed solution has either been legally challenged or politically blocked. The SAFE plan was blocked, mass loan forgiveness was struck down by the Supreme Court, income-driven repayment plans have been tied up in litigation. Meanwhile, according to the Federal Reserve, student loan debt is now the second largest type of household credit after mortgages, representing 9% of all household debt. In terms of what happens next, history gives us some clues about how this plays out. According to the research from the Federal Reserve Bank of New York, when large numbers of borrowers default on student loans simultaneously, it creates a credit crunch that affects the entire economy. Banks and lenders become more conservative about extending credit for everyone from mortgages to small business loans. This reduces economic growth even for people who don't have student debt because credit becomes harder and more expensive for everybody. So with all this in mind, are we absolutely doomed? Well, not quite. As you can see from historical economic data, there's plenty of examples where systematic debt problems were eventually resolved, but they typically required significant structural changes to how the system works. But you have to be patient and strategic about how you position yourself. As of now, the big picture, we're simply facing the consequences of a fundamentally broken system that encouraged people to take on unsustainable debt or credentials that don't provide the corresponding economic value. That's it. we're seeing the predictable result of what happens when you have massive amounts of debt, chasing degrees that don't actually improve earning potential, at least not enough to justify the cost. Does this mean the entire economy is going to collapse? No, but it does mean we're likely going to see a prolonged period of reduced consumer spending, higher default rates, and economic growth that's significantly below what it could have been if we had a more rational system. I mean, there's certainly a chance that some kind of massive federal intervention stabilizes the situation, at least temporarily, or there's a chance that this is just the beginning of a much larger economic restructuring than people realize, and that the traditional college to career pathway is fundamentally broken. That's why I think no matter what happens, it's always important to be prepared and position yourself strategically. So here's what I recommend. The number one thing is to always keep a 3 to 6 month emergency fund available at all times. This way, you're not gonna have to make desperate financial decisions if your income gets reduced or if you need to change careers quickly. An emergency fund should be able to hold you through whatever economic turbulence we're facing. Second, it's really important to develop recession-proof skills. Just like the tech industry lost about 78% of the jobs during the dot-com bubble, if you're all in on industries that depend heavily on consumer discretionary spending or could be disrupted by AI, there's a chance you could face significant income disruption. At the end of the day, the more skills you can develop that are essential rather than optional, the more insulated you're gonna be when the economy contracts. And that's what I've been focusing my business on personally. I try to provide essential services rather than luxury services. So if consumer spending drops, I still have revenue sources from people that can't cut it from their budgets. Third, speaking of recession-proof skills, this is actually why I started my company, CourseCareers, in the first place. When I was 18, I realized that college was going to saddle me with massive amounts of debt for a degree that probably won't even lead to a good job. So instead, I learned technology sales online, landed my first professional job when I was just 18 years old. And by 19, I was making $80,000 a year with no debt. And I then used the money and skills I learned from that job to start CourseCareers. That experience taught me that there are really specific skills and career paths that provide excellent income potential without requiring expensive degrees or years of education. And that's why CourseCareers focuses on teaching practical skills for careers like tech sales, IT, plumbing, construction project management, and supply chain. Industries where you can make 70 to 100,000 plus per year without any college debt. Now, I'm not just saying this to pitch our courses. I'm saying this because the student loan crisis we're discussing is exactly why alternative career paths are becoming so important. When the traditional college system is creating massive economic problems, it's time to consider different approaches. In case you're interested in learning new skills and starting a career that's in an in-demand field and will survive this collapse, I'll include a link to CourseCareers down below for you to check out. Fourth, don't panic about the broader economy, but do start positioning yourself strategically. I've noticed that the psychology that causes people to make poor financial decisions during economic uncertainty is really the same psychology that causes them to ignore obvious signs and warning signals. You need to resist both extremes. Don't panic, but don't pretend this isn't gonna happen either. Just stay informed and make rational decisions. On top of that, another aspect to consider is that economic disruptions, while painful, also create opportunities. According to various studies on economic cycles, some of the most successful businesses and careers are built during times of economic uncertainty, because there's less competition and more need for innovative solutions. Step 5, always maintain multiple income streams. The biggest risk I see with an economic contraction like this is that you depend on a single source of income. That becomes extremely dangerous. Whether that's a job, a business, or investments, diversification becomes critical when economic conditions are unstable. Ultimately, you want to make sure you have income sources that aren't all dependent on the same economic factors. So if consumer spending drops or AI takes away your current role, some of your income streams might be affected, but others might actually benefit. And finally, 6, if you're currently considering college or have children who are, you need to seriously evaluate whether the debt to income ratio makes sense. I know statistically that college graduates earn more than high school graduates on average, but those statistics are based on historical data, And of course, we know you can make future decisions based on past experience. Just kidding, that's really not smart. When you're looking at current student loan costs versus current starting salaries, the math often just doesn't work. If you're gonna take on massive debt for education, make sure you're getting skills that directly translate to income that can service that debt. Oh, and then in honorary number 7, if you currently have student loans, don't ignore them. Even if you're struggling with payments, contact your servicer and explore options before you default. Defaulted student loans create problems that can last for decades and affect everything from your credit score to your ability to get professional licenses. That's why I see strategic career planning and skill development as essential, not optional. And if you aren't prepared to navigate an economy where traditional pathways are increasingly risky, you need to start developing alternatives now. Ultimately, time is going to tell how this plays out. Typically, we see some of the best opportunities emerge after the worst economic disruptions. So I wouldn't be surprised if the next few years create some incredible opportunities for people who are positioned correctly. But it's going to be a challenging time for people who are unprepared or are carrying too much debt relative to their income. Let me know what you think down below in the comment section. I'll do my best to read as many as possible. And thank you so much for being able to watch a video like this. I put a lot of work into researching these economic trends and breaking them down in ways that actually help you make better decisions. Just hit that subscribe button, it's free, and it helps me continue making content just like this. Thank you so much, and until next time.